Okay, let's dive right in. We're breaking down an analysis of a company that is, quite literally, at the heart of India's massive transformation, KEI Industries. If you really want to understand the engine room of modern India, you've got to look at the company's wiring it all together. So let's just start with a number. And this one, well, it almost sounds made up, 111 lakh crore rupees. To put that in perspective for you, that's well over $1 trillion US dollars. It is a staggering amount of money, and it represents one of the biggest national projects happening anywhere on the planet right now. So you gotta ask, right? What on earth is India building with all that capital? Because this isn't just a number on a page, it's a huge statement of ambition. And here's your answer. All that money is funding something called the National Infrastructure Pipeline. It's this massive, coordinated plan to upgrade and expand basically everything. We're talking power grids, railways, smart cities, renewable energy, the works. It's a complete national overhaul. You know that old saying, right? In a gold rush, don't dig for gold. Sell the shovels. Well, that's the core idea here. When everyone is focused on building these massive projects, the companies supplying the essential tools and materials are in a really powerful position. And that, right there, brings us to our shovel seller, KEI Industries. They make the crucial cables and wires that are the veins and arteries for this entire infrastructure boom. Without their products, nothing works. The lights don't turn on, the trains don't run. It's as simple as that. And look, they aren't a one-trick pony, not at all. Almost half their money, about 45%, comes from those big, heavy-duty power cables for the grid. Another 30% from specialized industrial cables, and a really solid 25% from the wires that actually go into our homes. So they're covering the whole electrical ecosystem, from the power plant right to your plug socket. Okay, so the story sounds great, right? But does the math check out? Let's take a look under the hood with a financial health check and see how KEI is actually performing. All right, first number for you, 22.1%. That's their average revenue growth every single year for the last 5 years. You know, that kind of consistent, high-speed growth? It's just incredibly hard to pull off. It's a huge sign that they're successfully grabbing a piece of that massive demand we were just talking about. But get this, and this is where it gets really interesting. Their profit growth is even faster. We're talking almost 26% a year. And that's a critical insight. It tells you they're not just getting bigger, they're getting smarter and more efficient as they grow. More of every dollar they make is hitting the bottom line. And that brings us to what's basically the company's report card. It's called Return on Equity, or ROE. Think of it as a grade for how well management is using investors' money to make more money. KE score? 18.6%. Anything over 15% is generally seen as pretty strong, so yeah, they're getting an excellent grade here. All right, so the numbers look pretty solid. I think we can all agree on that. But hey, no company is perfect, right? A good analysis always looks at both sides of the coin. So let's dig into the strengths versus the potential concerns that the report flagged. So on one side, in the pros column, you've got this massive tailwind from the infrastructure boom, a proven history of growth, and their market leader. That's all great. But on the other side of the ledger, you've got some real concerns. Things like needing a lot of cash just to run the business day to day, the prices of raw materials like copper jumping all over the place, and of course, being pretty dependent on government spending cycles. Now, that term, working capital, might sound a bit like jargon, but it's super important here. Let's just break it down. Think of it as the cash a company has to keep tied up to pay its bills. Buying materials, paying salaries, before its customers actually pay them. The analysis points out that KEI has a lot of cash locked up in this cycle, and if that's not managed carefully, it can really put the brakes on growth. So you weigh the impressive growth against these valid concerns. What's the final call? What's the bottom line from the report's analysis? Well, the analysts didn't just guess. They actually mapped out a few different ways the future could go. And look at this. They give a 65% chance to the base case, which is basically the company continuing on its really strong path. That shows a ton of confidence, while still admitting, hey, there's a smaller chance things could go even better or a little worse. And all that confidence boils down to this, the final recommendation from the source report. A buy rating. They set a target price of 4,850 rupees, which at the time they wrote this suggested a potential upside of over 13%. So let's just tie it all together. Why the buy rating? It really comes down to 4 key things. 1, it's a pure, direct way to invest in that huge India infrastructure story we started with. 2, you saw the numbers. That financial track record is just fantastic. 3, they're a big fish in their pond, a real market leader. And 4, they're not just looking at home, they're growing their export business, which is always a smart move. Which really leaves us with this final thought. The analysis makes it pretty clear that KEI Industries is woven into the very fabric of India's growth. So the question for an investor is pretty straightforward. With an entire nation literally under construction, is this the wire that connects your portfolio to India's future?